Hello and welcome to the Business Standard Morning Show. I'm Debarghe Sanyal and here are the top stories for the day. Once considered too big to fail, Ruia brothers owned Essar Group had to sell its flagship assets in India to stay afloat. It scraped through the crisis and finally became debt-free in November last year. One of the key assets that the Ruia brothers had to let go was their loss-making steel business. Now, 3 years after selling the Essar steel, the group has been making a quiet foray into the steel business again. So, can Essar regain the lost ground? Find out in this report. Indian billionaires Shashi Ruia and Ravi Ruia, commonly known as the Ruia brothers, have seen quite a few upheavals. Once among India's top business houses, their group Essar's debt had ballooned from less than rupees 28,000 crore in 2009 to about rupees 1.83 lakh crores in 2017. The group brought it down by rupees 1.4 lakh crore over the next few years. And in November last year, the company finally declared that it was debt-free. But in this process, Essar Group had to sell several priced assets over the years. Essar Steel was one of them. It had landed on the Reserve Bank of India's defaulter list. ArcelorMittal and Japan's Nippon acquired it through a corporate insolvency resolution process in 2019. But now, the Ruia-promoted multinational conglomerate is making a comeback to the steel sector. The group is expanding its global footprint in 3 mega projects with an investment of $8 billion over 3 to 4 years. These include a steel plant in Saudi Arabia and an iron pellet plant each in Odisha and Minnesota of the United States. Now, with its debt cleared as it heads back to the steel market, what are the major challenges Essar is likely to face?
They are a group whose reputation is in tatters, both from at the debt funder side as well as equity funder side. Neither of the capital providers have been satisfied by the Essar. If anything, the promoters are not known to be very good on corporate governance. It's not sure where this 8 billion is going to come from, unless they have investors who are foreign in nature, who are willing to back them, who are new. I don't think Indian banks would be interested in funding any Essar projects because of their past history. They tom-tom by saying that they have paid back 2 lakh crore of debt, but I think many of the Indian banks have taken a lot of haircut.
And so, what should be on Essar's strategy card?
Main factors that will drive Essar's success going forward will be full enablement of manufacturing 4.0 ideas. It's very clear that they have created a supply chain which goes through multiple geographies. They've sought to capture the advantage of the US in terms of availability of people and technology, the advantage of Saudi Arabia in terms of low cost of power. And in India, they are hanging their hat on the market, which they already were familiar with. Essar Group must make sure that their governance is of the absolute immaculate highest quality. They must be extremely disciplined about their finances.
Equipped with some hard lessons from its past, the conglomerate's future journey will be much easier if it runs a tight ship. Speaking of steel, here is an interesting fact that Union Minister Piyush Goyal recently pointed out. He said Korea and Japan will buy steel from their domestic market even if it costs them $100 more for every ton due to their nationalist spirit. But they will not buy from an Indian supplier. At the same time, due to the free trade agreement, two Korean car companies, Kia Motors and Hyundai, have been costing India billions of dollars in trade deficit as they continue to import indiscriminately. So, have we benefited from the FTAs? Tariq Ahmed's report brings the answer.
The Korean industry, auto industry, Hyundai and Kia, are clearly two of the laggards. They've enjoyed the benefits of our free trade agreement with Korea and Japan and continued to import indiscriminately. So they've cost us dear.
That was Piyush Goyal, Union Minister of Commerce and Industry, at a recent event in Pune, talking about India's domestic manufacturing capacities and how some foreign automakers have benefited from India's free trade agreements. The government now aims to offer domestic manufacturers greater access to global markets and benefit from its free trade agreements or FTAs. In 2022, India signed free trade agreements with UAE and Australia. Before these and another trade agreement with Mauritius in 2021, India had taken a decade-long break from signing new FTAs. Currently, India is part of 13 FTAs, most of which are with South and East Asian countries. But now that's changing. India is presently in negotiation with the European Union, UK, and Canada for a bilateral free trade agreement. So why is India showing enthusiasm to sign more FTAs? COVID-19 and Russia-Ukraine wars disrupted global supply chain, leading to a scarcity of essential materials and services around the world. The same scarcity had made India realize the importance of diversifying the sources of its essential imports. India also has ambitious plans to achieve $2 trillion export target by 2030. Through new bilateral free trade agreements, the country is looking for potential markets to export. But are the existing free trade agreements beneficial for India?
The trade deficit, the rising trade deficit has been one of the major problems with the FTAs. And that was also the reason why India walked out of RCEP negotiations.
Though India's total export has increased over the years, imports are also on the rise, leading to the rising trade deficit. As free trade agreement allows the countries to conduct trade at heavily discounted tariff rates, the increased trade deficit suggests that India needs to step up its exports.
My view is that it's really the export side. We are not able to export well enough. And this is again showing up in this financial year, because after our tremendous performance in 21-22, in 22-23, this financial year, exports have again started slumping. Yeah. So the major problem for us is that we're not able to our industry, our different sectors, agriculture industry, is not competitive enough. It's not competitive enough to take the more efficient firms and the countries in the global markets.
However, Amitabh Batra of the Jawaharlal Nehru University believes the FTAs shouldn't be held liable for the increasing trade deficit. It is the inability of the domestic manufacturers to take advantage of the existing FTAs through competitive exports, she believes.
Our export basket, that has not changed much. The export basket does not have any significant major change, in terms of increasing the manufactured component in it. Plus, as far as our manufacturing value addition is concerned in the exports, that has declined over time. So in that sense, the important thing here underlying the entire export trend is manufacturing competitiveness, lack of participation in global value chains, not doing FTAs with the right countries, designed right so as to be able to take advantage of FTAs as a means to participation in value chains.
For India to take advantage of the FTAs, experts believe manufacturing and export competitiveness should be achieved, followed by the identification of right partner countries and agreeing on well-negotiated deals. India's move to sign free trade partnerships with EU, UK, and Canada has the potential to iron out restrictive measures that function as a barrier to exporters and open up new markets for domestic businesses.
China on Sunday set a 5% growth target for 2023, lowest in more than 25 years, as it swiftly reopens its economy from COVID-19 restrictions. This could help the Indian metal industry. So, should investors bet on the stocks? Harshita Singh's report has the answers.
The gradual emergence of the Chinese economy from its zero-COVID restrictions and the ease in input costs has lent support to stocks of metal companies recently. In the past week, the Nifty Metal Index has bounced back by over 4% as investors grew hopeful of firm demand ahead. In comparison, the NSE Nifty Index gained 0.7%. Market experts, however, believe that China's reopening may not lead to any significant pickup in demand for metals amid persistent global worries and China's cautious growth target.
So I think looking at the current data and expectation of Chinese reopening, personally right now I don't think it could be a big demand driver for metals like steel, aluminium, or copper. And the domestic sectors like travel, tourism, service should benefit more, with the China reopening. In addition, with the recent announcement and the GDP target of 5% which China has given out, I think it's in the lower end of the spectrum. And unlike previous times, once after the financial crisis and just, after the COVID, the kind of appetite they had announced, I think this time the boost is not there. So I would not lay a lot of emphasis on the demand for metals picking up just because China is reopening.
That said, companies are likely to see better spreads and margins in the ongoing quarter amid declining prices of key raw materials like coking coal and a rise in hot-rolled coil or HRC prices. Last week, the spot HRC spread rose to 27,050 rupees per ton, which was the highest in the last 2 months as coking coal prices fell 11% on a weekly basis. According to ICICI Securities, the improvement in domestic spot spread due to lower coking coal price comes as a relief for steel players. However, we believe that China still remains the key. While the real estate market in China is showing initial improvement, we await more clarity on stimulus measures and their impact on the overall steel demand. Maintain our cautious outlook on the sector with JSPL and Shyam Metallics as our key picks. Meanwhile, the domestic demand for the sector is likely to remain robust given the government's infra push.
Domestic demand in India is quite robust, and Q4 being the strongest quarter, domestic steel mills are not facing demand constraints in domestic markets. Demand for long steel has remained firm on the back of government's push to fast-track infrastructure projects, and HRC flat has witnessed a price hike of about 1,000 rupees per ton, week on week to 59,300 per ton. Indian markets have slowly started scouting European markets post the rollback of export duty and constraints faced by Turkey to supply to European markets post the earthquake. Near-term outlook seems to be positive with price hikes expected in the coming weeks.
Hence, a firm turnaround for the metal sector hinges on the global growth dynamic. Analysts suggest investors pick companies which are vertically integrated and have good cash flows with well-secured funding for their expansion plans.
TCS, the country's second largest company by market capitalization, recently tried to allay fears of job loss around generative artificial intelligence. The company, which employs over 600,000 people, said that the platforms like ChatGPT will create an AI coworker and not replace jobs. But what exactly is generative artificial intelligence that everyone is talking about? We decode it for you.
Generative artificial intelligence might not think like a human brain does, but it sure can mimic it. It can produce original content based on the data it has been trained on. Take ChatGPT for example. It has been trained on a vast text-based data set till the year 2021. The training was a type of machine learning called neural network. As the name suggests, it is somewhat based on mimicking the neuron cells of a human brain. Hence, ChatGPT can analyze the text it has been trained on, and based on the input it gets from the user in the chat box, it responds with text which appear original in nature. However, these responses are usually similar to the original text used to train it. And it is not just the ChatGPT. Today, generative AI can produce original videos, music, and art. DALL-E and Midjourney are examples of creative arts, while Pictory generates high-end videos. But how does AI produce such intelligent content? They are based on Generative Adversarial Network or GAN, and it is composed of two types of neural networks, generator and discriminator. Both are machine learning programs but trained for different purposes. The generator network allows AI to analyze the data set and use it to create content. The discriminator, on its part, studies the produced content and decides if the said content is real or fake. This goes on, and the content produced by AI keeps getting better, or to say resembles closer and closer to the data set on which it was trained. Generative AI is likely to change the way several industries work. It can not only analyze complex data sets and suggest changes to increase revenue, but also study satellite weather graphics and predict weather changes. It is being extensively used in the medical industry as well. The future of work will be vastly different and hopefully equally exciting.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
But the fears of job losses due to AI may not be totally unfounded. A recent McKinsey study has claimed that artificial intelligence could displace roughly 15% of workers worldwide between 2016 and 2030. That's all for today. For more news and analysis, please log in to business-standard.com.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.